Welcome to Money Talk with Michael. I'm Michael Eastham, president of Fellowship Financial Group. Money Talk with Michael is our weekly broadcast where we answer your questions about finance, investment, retirement, and all things related to money. Remember to send in your questions to the email listed in the description box below, and you might hear your question answered on the next Money Talk with Michael.
I am 66 and my husband is 65. We both recently retired. I took a buyout option at my company and took a lump sum pension of $350,000. Our combined 401ks are $700,000. My Social Security is $32,000 and his is $18,000. We need about $85,000 in income to do everything we want in retirement. We've worked hard to save over the years and are concerned about how stock market losses later in life may impact our retirement dreams. But right now, my financial advisor says we are in conservative mutual funds. What can we do?
Okay, well, thanks so much for that question. Now, you got a lot of numbers in here, so I'm going to try to work them out in my mind. Now, if I remember correctly, you've got about $50,000 in combined Social Security, but you need about $35,000 more to fill the gap between what your desired income is and what your Social Security is. Now, this is a classic case of the wrong strategy for income. Why? Because even if those mutual funds are conservative mutual funds, well, best case scenario, you're getting maybe 2% in income. That's $20,000. You're still $15,000 short of your goal. But if you're paying a financial advisor fee of 1% and the mutual funds, they're charging you 1%, well, then there goes your $20,000 out the window. You have no predictable income from those mutual funds. In fact, you're pretty much dependent upon the stock market increasing every single year to replenish that $20,000 or that $35,000 that you need to take out. And you don't need me to tell you that the stock market doesn't go up every single year. You've got to make sure that you understand this, because if you're selling shares, which is what you have to do in your mutual funds to generate income, and the stock market is down, well, you're going to be reverse dollar cost averaging. That's one of the most dangerous financial strategies that people take on in retirement, especially in the early years. Why? Because when you sell principal in a down market, when it's down by 30, 40, 50%, you're selling twice as many shares at the bottom of the market as you did at the top of the market to generate the same amount of income. And when the stock market does come back, and look, I believe it always does over time, but when it does come back, in your case, that principal is not coming back. It's gone, and gone forever. So make sure that you understand that aspect of it. This is when you need to make sure that some portion of your investments are shifted into a strategy that produces interest and dividends on a regular basis. Why? Because that interest and dividends becomes a renewable resource. If you take the interest and dividends or the predictable income that you're receiving from those investments, then the principal is going to regenerate that investment again the next year. So that's how you fill the income gap and sleep well at night. Every situation is going to be a little bit different. Some of you may be able to use some of your assets and invest for income, and use some assets and invest for growth. Every situation is a little different, and I need to see a little bit more details about your particular situation to give you a solid, confident answer there. Hope that helps, and thanks so much for that question. Thanks so much for watching. Tune in next Monday for another edition of Money Talk with Michael. And don't forget to send in your questions and check out our website at fellowshipfinancial.com and our social media platforms. And if you'd like, you can schedule a 15-minute complimentary call to get your specific questions answered. Everything you need is listed in the description box.